Imagine this: decades of saving, sacrifices, and smart investments all lead up to the moment you finally retire. And yet, you're left wondering if your money will actually last. For years, financial planners told us that if we followed the 4% rule, withdraw 4% of our nest egg each year, we'd be safe. It sounded simple, reliable, almost magical. But today, many are asking, is that rule still alive, or has it quietly died, leaving millions exposed? Let's unpack what this really means for anyone planning their retirement. The 4% rule started as a simple concept that quickly became a cornerstone of retirement planning. Its origins trace back to decades of research where analysts examined historical market returns, inflation rates, and retirement spending patterns to create a guideline that would help retirees avoid running out of money. The rule suggested that if you withdrew 4% of your retirement savings in the first year and then adjusted that withdrawal for inflation every subsequent year, your portfolio could theoretically last for 30 years. It wasn't just a random number. It was carefully derived from data that balanced growth potential with sustainable spending. For those approaching retirement, this concept offered clarity and reassurance. People suddenly had a concrete figure to plan around, a starting point that allowed them to visualize their financial future with some sense of security. It transformed retirement from an abstract fear into something measurable and manageable, giving decades of savers a clear roadmap to follow. However, the 4% figure was based on very specific historical conditions. The studies assumed a mix of stocks and bonds, relatively predictable market behavior, and inflation rates that stayed within moderate ranges. Life expectancy at the time was also shorter, meaning that 30 years was often more than enough to cover retirement. The withdrawals were meant to be steady, creating a balance between spending and preserving capital. It was a rule designed for an era in which the financial landscape was different, yet it worked well within its parameters. The simplicity of the 4% rule was part of its appeal. People didn't have to model complicated investment scenarios or worry constantly about adjusting their portfolios. The math was straightforward: determine your nest egg, calculate 4%, and plan your annual withdrawals accordingly. For many retirees, it became almost a mantra, a benchmark against which all other retirement strategies were measured. Yet, even in its original context, the 4% rule had limitations. It assumed that retirees would stick to a moderate lifestyle, avoid extreme market downturns, and not face unexpected medical or financial emergencies. It also relied heavily on past performance, assuming that historical trends would continue into the future. Despite these assumptions, it became ingrained in the financial culture because it provided an easy answer to a complicated question: how much can I safely spend without running out of money? It created a sense of control in a period of life that can feel unpredictable. Retirees could plan with confidence, knowing that statistically they were unlikely to outlive their savings. It gave people permission to enjoy their retirement, rather than live in fear of depleting their resources. Over the years, the 4% rule has been cited in countless books, seminars, and articles as a benchmark for safe withdrawal rates, solidifying its reputation as a fundamental principle in retirement planning. It represented a bridge between financial theory and practical application, turning abstract calculations into actionable guidance. The principle behind it was simple: balance growth and security, and use historical data as a guide. In its time, it provided a framework that worked remarkably well for those who followed it diligently. The 4% rule transformed retirement planning from guesswork into a disciplined, data-informed approach that millions relied upon to structure their golden years. Fast forward to today, and the financial landscape has changed in ways that make the 4% rule far less certain. Life expectancy has increased significantly over the past several decades. Many people entering retirement now expect to live well into their 80s or even 90s, meaning that the 30-year framework the 4% rule was built around may no longer be sufficient. Retirees are planning for longer stretches of time without a steady paycheck, which introduces the risk that a fixed withdrawal rate may deplete their savings before the end of their life. Additionally, inflation is no longer as predictable as it once seemed. While the original studies assumed modest and steady inflation, recent years have demonstrated that prices can spike unexpectedly, eroding purchasing power and forcing retirees to spend more than originally planned just to maintain their lifestyle. Rising costs for healthcare, housing, and everyday essentials create additional pressure on retirement portfolios. Even small deviations from the assumed rate of inflation can compound over decades, making a once safe withdrawal dangerously risky. Market volatility has also increased dramatically. Global events, economic shifts, political uncertainty, and rapid technological change all contribute to swings in the stock and bond markets that can be severe and sudden. A significant downturn in the first few years of retirement, a known as sequence of returns risk, can drastically reduce the sustainability of a fixed withdrawal rate. If retirees are forced to sell investments at a loss during a market dip, they may permanently damage the longevity of their nest egg, regardless of how much they initially saved. The 4% rule assumed relatively smooth market performance, but the reality is far less predictable, requiring retirees to navigate a landscape full of uncertainty and potential hazards. This unpredictability has left many questioning whether relying solely on a static formula makes sense anymore. Another factor undermining the traditional rule is the variety of retirement needs and lifestyles. People today may want to travel extensively, support family members, or pursue new ventures, all of which can create fluctuating spending patterns. A rigid 4% withdrawal rate does not account for personal goals, unexpected expenses, or changing priorities over a multi-decade retirement. It assumes a level of consistency that few individuals can realistically maintain over decades of life after work. Furthermore, the prevalence of alternative income streams, such as part-time work, gig opportunities, or investments outside the traditional stock and bond allocations, adds complexity that the original rule did not account for. Retirees today are navigating a far more complex financial ecosystem than previous generations. All of these factors, longer lifespans, unpredictable inflation, market volatility, and diverse spending needs, combine to create a situation where the traditional 4% rule may no longer be reliable for everyone. What was once a simple, data-backed guideline now faces serious challenges, as the assumptions it relied on are increasingly out of step with modern realities. Blindly following it could leave retirees underprepared, forcing them to make difficult financial adjustments in a period of life when flexibility is limited. For those planning their retirement, understanding these challenges is critical. Recognizing that the 4% rule is not a one-size-fits-all solution is the first step toward creating a more robust and adaptable plan that can withstand the uncertainties of the current economic landscape and ensure financial security for the decades ahead. Even though the 4% rule faces serious challenges in today's financial environment, it doesn't mean that retirees are without options. The key lies in flexibility and adapting withdrawal strategies to fit personal circumstances, market conditions, and evolving needs over time. One approach is to embrace dynamic withdrawals rather than adhering to a fixed percentage. Instead of automatically taking out the same adjusted amount every year, retirees can vary their withdrawals based on market performance, portfolio growth, and personal expenses. In years when the market performs well, slightly higher withdrawals may be possible, while in downturn years, pulling back can help preserve capital. This strategy reduces the risk of depleting the portfolio prematurely and aligns spending more closely with the realities of investment returns. By paying attention to these fluctuations, retirees can maintain financial stability while enjoying their lifestyle without being constrained by rigid rules. Diversifying withdrawal sources is another critical strategy. Instead of relying solely on a taxable investment account or a single portfolio, retirees can structure withdrawals across multiple accounts such as tax-advantaged retirement accounts, pensions, Social Security, and even side income streams. This layered approach provides flexibility, tax efficiency, and greater control over timing and amounts. For instance, drawing from accounts that are more tax efficient in certain years can minimize tax burdens and maximize longevity. Similarly, planning for a portion of retirement income to come from part-time work, rental properties, or dividend-producing investments adds an extra safety net. The ability to adjust the order, amount, and timing of withdrawals allows retirees to better navigate market uncertainty and unexpected expenses without compromising long-term financial security. Another strategy is to adopt a more conservative withdrawal rate initially and then adjust it over time. Starting with a lower percentage can give the portfolio room to grow during early retirement years, reducing the risk of running out of funds later. Retirees can gradually increase withdrawals as their comfort level grows or as the portfolio demonstrates resilience against market fluctuations. This approach also allows for intentional adjustments based on personal spending patterns, health needs, and lifestyle goals. Importantly, it encourages regular check ins on financial plans rather than a set it and forget it mentality. Regular monitoring of investments, expenses, and long-term goals helps identify potential issues early, allowing for timely modifications that protect both income and capital. Lastly, planning for contingencies is essential. Life is unpredictable, and unforeseen expenses, from medical emergencies to major home repairs, can strain retirement finances. Building a buffer within the portfolio or keeping a separate cash reserve ensures that these unexpected costs do not force drastic withdrawals or jeopardize long-term sustainability. By combining dynamic withdrawals, diversified income streams, conservative pacing, and contingency planning, retirees can create a framework that is far more resilient than relying on a fixed rule. The focus shifts from blindly following a historical guideline to actively managing money with awareness, discipline, and adaptability, ensuring that retirement is not just financially sustainable but also enjoyable and fulfilling. Securing a reliable and sustainable retirement requires a combination of careful planning, disciplined investing, and thoughtful spending habits. One of the first steps is to regularly review and update retirement projections. Life circumstances, market conditions, and personal goals evolve over time, so relying on a plan created years ago can be risky. By using conservative assumptions for investment returns and inflation, retirees can create a buffer that helps account for unexpected changes. This ongoing evaluation allows adjustments to withdrawal rates, asset allocation, and spending habits, ensuring that the retirement plan remains aligned with both financial realities and lifestyle objectives. Frequent check-ins prevent small problems from compounding into major shortfalls, giving retirees greater control and peace of mind. Investing strategically is another cornerstone of retirement security. Portfolios should be diversified across various asset classes, including stocks, bonds, and potentially alternative investments, to manage risk while still capturing growth opportunities. Diversification reduces the impact of market swings on overall wealth, and adjusting allocations over time can help balance risk and reward. Retirees might gradually shift toward more conservative investments as they age, but maintaining some growth-oriented assets is essential to keep up with inflation and extend the life of the portfolio. A thoughtful investment strategy goes hand in hand with withdrawal planning, ensuring that money is available when needed without forcing the sale of assets at unfavorable times. Combining growth potential with stability creates a foundation that can weather the uncertainties of extended retirement years. Spending habits also play a crucial role in preserving retirement funds. Developing a realistic budget that prioritizes essential expenses while allowing room for lifestyle choices helps prevent overspending. Flexibility is key. Being able to adjust spending during market downturns or unexpected life events ensures that retirees do not erode their nest egg prematurely. Tracking expenses, planning for discretionary spending, and maintaining a cash reserve for emergencies create a safety net that allows retirees to enjoy their retirement years without constant financial stress. The discipline to spend within means, while still accommodating occasional indulgences, helps maintain both financial and emotional well-being. Finally, having contingency plans strengthens overall security. Retirement is unpredictable, and unexpected events, medical emergencies, economic shifts, or personal obligations can put pressure on finances. By maintaining emergency funds, insurance coverage, and alternative income streams, retirees can address these challenges without jeopardizing long-term sustainability. Planning for longevity, including considering healthcare costs and potential long-term care, ensures that money lasts as long as it is needed. Strategic planning also includes considering part-time work, rental income, or other supplemental income sources to add flexibility and resilience to the retirement plan. By combining consistent evaluation, diversified investing, disciplined spending, and contingency planning, retirees create a comprehensive approach that maximizes the likelihood of financial security. This proactive mindset transforms retirement from a period of worry into a stage of freedom and choice, allowing individuals to enjoy their years fully while knowing their resources are protected.